We're diving into one of the most influential investment books ever written, A Random Walk Down Wall Street. In this deep dive, we'll explore the key ideas from Chapter 3. Get ready to join us on a fascinating journey through financial history. We're going to unpack why even, seemingly rational markets can sometimes go absolutely wild. And it's not just individual investors getting caught up, is it? Even seasoned professionals get dragged along for the ride.
Oh, absolutely. It's truly astonishing when you look back at the extent of, collective market madness. You'd think that professional portfolio managers, the ones handling huge sums in pension funds, mutual funds, advisory firms, they'd be immune, right? Immune to the kind of speculative fever that grips the general public.
Yeah, you'd expect a certain level of detachment, of cool-headed analysis.
But here's the central paradox. These institutional investors haven't just participated in major speculative waves, they've often led them. And it wasn't usually because they saw deep fundamental value. No, it was more about anticipating that a greater fool would come along and buy at an even higher price.
Ah, the greater fool theory. Buy high, sell higher, regardless of what the thing's actually worth.
Exactly. That idea where you buy simply because you believe someone else will pay more, it's a powerful and, frankly, often dangerous force in the markets.
Okay, let's unpack this. A good place to start seems to be the roaring 1960s. This era had what people called a new era, right?
Right.
Marked by this growth stock and new issue mania.
Mm.
The word growth itself almost took on this mystical quality. You had companies like IBM, Texas Instruments, real innovators, sure, but trading at absolutely astronomical price-to-earnings ratios.
Yeah.
Like 80 times earnings, sometimes even more. And just for context, a typical healthy PE might be, what, 15 to 20?
Yeah, maybe 15 to 20 is sort of normal, depending on the industry. So 80, that's investors paying for 80 years of current earnings for one share. An incredible bet on future growth. A bet that, let's be honest, very few companies can ever actually deliver on. And it's quite striking how, back then, if you dared to question those sky-high valuations, you were practically seen as, a heretic. Like, you just didn't get it. The belief was just so strong. Even if current prices couldn't be justified by fundamentals, the feeling was, someone else will eagerly pay even more tomorrow. It's like the economist John Maynard Keynes and his idea of building castles in the air in the stock market. He would have seen this coming.
Building castles in the air. That's a great way to put it.
The core lesson really is that a compelling story, no matter how flimsy the foundations, can temporarily just completely override rational valuation.
I've heard stories from that time, too. You had older investors, people who actually remember the 1929 crash, being super wary of these stocks. They wouldn't touch them. But it was the ambitious, maybe less scarred, younger crowd driving the market. There's that quote from a broker back then, something like, speculators thought whatever stock they bought would double overnight. The terrible thing was, it actually happened.
Yeah, that's the dangerous part, when the irrationality gets temporarily validated.
And it got even crazier, didn't it? With the whole tronics boom, companies would just vaguely tack the word electronics onto their names. Didn't matter if they had anything to do with electronics. People just didn't seem to care what the company did, as long as the name sounded sort of techy and cool. Like American Music Guild, they just sold records door to door. They changed their name to Audiotronics. Stock launches at $2, and boom, it hits $14 in weeks.
That's a perfect example. It really highlights the absurdity, like that famous story from Jack Dreyfus. He talked about this small, established shoelace company, right? Trading at a perfectly reasonable 6 times earnings, solid little business. But then it changes its name to, get this, Electronic Silicon Firth Burners Company, Inc.
Firth Burners, what even is that?
Exactly. Dreyfus joked that electronic and silicon alone were instantly worth a 15 PE multiple in that market. But the real kicker was Firth Burners. Nobody knew what it meant, and apparently a word nobody understands was worth doubling the PE ratio.
Doubling it.
Yeah. So you take the shoelace PE of 6, add 15 for electronic, and silicon gets you to 21. Then double it for Firth Burners. Suddenly, your shoelace company is trading at 42 times PE.
That's just madness. Pure fantasy, dressed up as innovation.
Pretty much.
And the sad reality, of course, was that a decade later, most of these tronics firms were worthless. Vanished.
They just disappeared, which raises the question.
Where was the oversight? What about the SEC?
That's a vital question. Where is the SEC, the Securities and Exchange Commission? Well, they did require companies to prepare compliant prospectuses, and those prospectuses often had these bold warnings, things like, this company has no assets, no earnings, cannot pay dividends, highly risky.
Like the warnings on cigarette packs, basically.
Exactly like that. But just like those warnings, they couldn't stop determined speculators. The SEC could warn the fools, but they couldn't prevent them from, well, squandering their money. What they could do, and did, was crack down on outright fraud and market manipulation, especially by some of the sketchier brokerage firms involved. But the key lesson from the tronics boom is just how fast a new concept, even a vague one, can sweep up investors. Appearance often trumps reality in these frenzies.
So the tronics boom fades out around 62. But Wall Street needs its next fix, right?
Yeah.
By the mid-60s, there's a new magic word, synergism. This became the big idea behind the conglomerate wave. The promise was that 2 plus 2 could somehow equal 5 after a merger.
Yeah, synergy. And it's fascinating how they went about achieving this supposed synergy. Antitrust laws made it hard for big companies to buy competitors in their own industry. So they started looking outside, buying companies in totally unrelated fields.
Okay.
And the growth they showed, it was often presented as this great benefit of the merger. But really, the driver was often just financial engineering, pure accounting tricks. Conglomerate managers got really good at manipulating earnings per share rather than actually improving the businesses they bought.
How did they do that?
Well, they'd exploit accounting rules, or, more commonly, the difference in PE multiples. Take Abbott Circuits, an electronics company with a high PE. It acquires Baker Candies, a low PE company. By swapping stock, Abbott essentially buys Baker's earnings cheap at Baker's low multiple and then sells them to the market at Abbott's own high multiple. Boom, instant earnings per share growth, even if neither business got any better.
Wow. Okay, so it's paper growth, not real growth. There was a real-world example, right?
Yeah.
Automatic Sprinkler Corporation, later Figgy International. Their sales grew like 14 times between 63 and 68, purely through acquisitions, buying low PE companies using that trick.
Yeah.
And the market loved it. Their PE shot up to over 50 times in 67.
Oh, yeah. And the CEO, Mr. Figgy, he was a PR genius. He'd talk about freeform energy and core technological fulcrums, this whole new language that just baffled and impressed investors.
Baffled is probably the right word.
Totally. Nobody really knew what it meant, but it sounded incredibly sophisticated. Zinc mines became aerospace minerals divisions. Steel mills were materials technology divisions. If an analyst asked how a foundry could grow 15–20% a year, they'd get some story about efficiency experts and new markets. And the crazy thing, the PE ratios of these conglomerates actually rose with all this merger activity.
Until the music stopped, which it always does.
Always does.
January 19th, 1968. Litton Industries, a huge conglomerate name, suddenly announces earnings will be way lower than expected. This was a company that had grown earnings like clockwork, 20% a year for nearly a decade. So the news hit like a ton of bricks. Shock, disbelief.
And then the selling started, a total frenzy. Conglomerate stocks just plummeted like 40%.
Ouch.
Looking back, two big things came out of that phase. First, investors finally clued in that managing these sprawling, unrelated empires was incredibly hard. The whole 2 plus 2 plus 5 idea, clearly false. Some even started wondering if 2 plus 2 still equaled 4.
Right. The complexity caught up.
And second, the government and accounting bodies, the FTC, the SEC, got seriously concerned about how these mergers were happening. That led to regulatory changes making the earnings growth game much harder to play. And quick historical footnote, fast forward to the early 2000s, and the trend completely reversed. Deconglomeration, spinning off subsidiaries, became the hot strategy to boost value.
Interesting how things swing back and forth.
The lesson, though, is that financial engineering can only hide the cracks for so long before reality bites back.
So conglomerates fall apart. What's next? Mutual fund managers needed a new mantra, and they found it. Performance.
Yeah.
This kicked off the concept stock bubble. Simple idea.
Yeah.
Make your fund stocks go up faster than the other guys and you attract more money.
Yeah.
All about rapid appreciation.
Exactly. And some funds had incredible, if brief, success. Remember the Enterprise Fund, Fred Carr ran it, delivered a massive 117% return in 1967.
Wow.
That fueled the rise of these go-go funds and their managers, the aggressive young gunslingers, they called them. Fast trading, high risk. They chased dynamic stocks with really compelling stories, shifting capital quickly to the next big narrative. And the appeal wasn't necessarily that the story was true, it was the belief that other people would believe it and drive the price up.
Cans again. Believing what others believe.
Precisely what he talked about back in 1936. Still relevant.
My favorite story from this era has to be Cortez W. Randell and his company, National Student Marketing Corporation, NSM. This guy was a character, master of self-promotion. Had a white Learjet called Snoopy, fancy apartment castle in Virginia, a yacht.
Living the high life.
Totally. Wrote a book, did anti-drug ads, projected this image of a super successful, dynamic entrepreneur. And his concept, NSM, could cater specifically to the booming youth market. Like the conglomerates, NSM grew through acquisitions, but everything he bought was somehow tied to college kids, posters, records, summer job directories, you name it.
It's all about the story, right? And then you get the really extreme examples, like Mini Pearl. Started as a fast food franchise company, changed its name to Performance Systems purely to appeal to those performance-chasing investors.
Performance systems, not subtle.
Not at all. And at its peak in 1968, this company had zero earnings, none, which gave it an infinite PE ratio.
Infinite PE. How does that even...
Think about it. You're paying an unlimited amount per dollar of earnings because there are no earnings. You were buying nothing but pure hope, or maybe pure delusion.
So why did these concept stocks blow up so spectacularly in the end? Well, first, those ridiculous PE ratios. If a PE drops from, say, 100 down to a more normal 20, that's an 80% loss right there.
Yeah, the math is brutal.
Second, lots of them ran into serious operational problems. They expanded too fast, took on too much debt, management lost control. The founders often weren't great operators.
Storytellers, not managers.
Exactly. And third, unfortunately, there was just plain fraud. Cortez Randall himself ended up pleading guilty to financial fraud.
Right.
So the lesson seems to be the danger of investing just based on a sexy story or a charismatic leader with no real substance or profits underneath.
It seems like a cycle.
It really does. After the craziness of the 60s bubbles, Wall Street pros in the 70s basically took a vow, okay, enough of that, back to sensible investing. Out went the concept stocks. In came the blue chip companies. The idea was, you know, these giants like IBM, Xerox, McDonald's, they won't collapse like those speculative plays. You could just buy them and, I don't know, sleep at night.
And that led straight to the Nifty 50 craze, about 50 high-quality, big, well-known growth stocks. Household names. The thinking behind it was multi-layered. One, they seemed safe. Two, institutions could buy large amounts without moving the price too much because they were so big. Three, the belief was, okay, maybe the price is high now, but their amazing growth will eventually justify it. And four, maybe most importantly, the security blanket effect.
Security blanket.
Yeah. Nobody would fire a fund manager for buying IBM, right? If IBM went down, well, everyone lost money on IBM. It wasn't seen as some reckless gamble. It was the safe, prudent choice, even at a high price.
But the flaw, the big fallacy, was that these same institutional investors just ignored the math again. No company, doesn't matter how great, can grow fast enough forever to justify an 80 or 90 PE ratio. It was just foolishness, dressed up as wisdom again. How does that keep happening, that collective suspension of disbelief?
It's often that social proof, you know, the comfort of the crowd. If all the other smart professionals are doing it, it must be okay. And, like all these speculative episodes, the Nifty 50 party had to end. It was the very same institutional managers who first loved these stocks who eventually woke up and realized, whoa, these are way overpriced. They started selling, and that led to a major crash for these former darlings. The premium just vanished.
So even the best companies aren't immune to becoming bubbles.
Absolutely not. When valuations detach completely from reality, even quality doesn't save you from the eventual fall. The lesson? Price always matters.
And here we go again. The early 1980s. New issue mania rages again. It's almost like a rerun of the 60s, isn't it? Yeah. Just swap out tronics for new buzzwords like biotechnology and microelectronics. In 1983, the total amount raised from new stock issues, IPOs, actually exceeded the combined total for the entire previous decade.
The market was just ravenous for IPOs again. Anything new and exciting. You had some really quirky examples preparing to go public, like Androbot, planning to make robots for your home, and a New Jersey company called Stuff Your Face, Inc. Yes. They only had 3 restaurants, but they were getting ready for an IPO.
Stuff Your Face, Inc. Seriously.
Seriously, the demand was just there for anything with a story.
And then there was that truly bizarre case, fine art acquisitions. This wasn't just some fast food joint. It was pitched as this highbrow artistic venture. Their prospectus actually listed a collection of nude photos of a very young Brooke Shields as a major asset.
I remember that. Unbelievable.
Her mother obviously was not happy, sued, got the photos back. The company changed its name later and eventually failed anyway. Just, wow, stranger than fiction.
It really is. And looking at the whole picture of that early 80s new issue boom, it seems like the offering that might have finally popped the bubble was Muhammad Ali Arcades International.
The boxer.
Yeah. The offering itself wasn't that different from other junk issues, but it had this unique structure. A share of stock and 2 warrants, all for just 1 penny.
A penny.
A penny. A warrant, remember, gives you the right to buy more shares later at a set price. Anyway, the turning point seemed to be when people found out that Muhammad Ali himself hadn't bought a single share of the company bearing his name.
Ooh, that doesn't look good.
Not at all. It made investors pause and actually look at what they were buying across the small cap sector. And they didn't like what they saw. That whole sector tanked. Many investors lost like 90% of their money in just a year.
Ouch. Another brutal lesson.
The lesson?
Mhm.
Celebrity names and hype might inflate things for a while, but if there's no substance, gravity eventually takes over.
Okay, so from new issues in general to a specific hot sector, the 1980s also gave us the biotechnology stock bubble. You mentioned it felt like the tronics boom.
Very similar vibe, absolutely. The optimism around genetic engineering was just huge, off the charts. Genentech was the poster child. When they went public in 1980, the stock almost tripled in the first 20 minutes of trading.
20 minutes.
20 minutes. Analysts were forecasting billions in sales for drugs like interferon, even though the reality, years later, was much, much lower. They kept predicting earnings would explode and kept being wrong.
So if there were no earnings, minimal sales, how on earth did they value these companies?
Well, they had to invent new ways. There was this thing called the product asset valuation method. It basically involved estimating the future value of all the products the company had in the pipeline, even if a product was literally just a sketch on an engineer's notepad.
You're kidding. Valuing napkin drawings.
Essentially, yes. Valuing potential sales, potential profit margins of ideas that barely existed. It was pure speculation on future breakthroughs.
Were people just ignoring the obvious potential problems? Like, what about FDA delays? Or could the market even afford the super high drug prices they expected? Patent fights, profits going to big pharma partners.
In the mid-'80s frenzy, it seems those concerns just vanished. Poof. I remember one analyst actually arguing that biotech stocks were less risky than traditional drug companies.
Less risky. How?
His logic was, and I quote loosely here, biotech companies have no old products whose sales are declining to offset.
That's insane. Having actual sales and profits is a disadvantage.
Complete inversion of logic. Of course, reality hit eventually. Most biotech stocks ended up losing 3/4 of their value or more.
Wow.
The takeaway there is crystal clear. Valuing pure potential, especially in complex new fields without any tangible results, is just asking for a speculative disaster.
And maybe the ultimate cautionary tale of the 80s, the one that sums up the excess and, frankly, the potential for outright deception, has to be the ZZZ best company bubble. Barry Minkow. It was pitched as this incredible American dream story, right? Kid starts cleaning carpet, becomes a millionaire by 18. Horatio Alger stuff.
Oh, Minkow's story was amazing on the surface. Started cleaning carpets at 10, company at 15, millionaire by 18. He knew how to create an image. Red Ferrari, mansion with a Z in the swimming pool, wrote a book called Making It in America, even did anti-drug commercials. Total self-promoter.
And he told Wall Street his carpet cleaning company was bigger than IBM in its field, the General Motors of carpet cleaning.
And people bought it. Investors listened, incredibly.
Until the shocking truth came out. ZZZZ Best wasn't just cleaning carpets. It was a massive front.
Yeah, a huge money laundering operation and a classic Ponzi scheme. Fake contracts worth millions, totally fabricated credit card charges, just shuffling money around, scamming you investors to pay off old ones.
And Minkow himself was accused of pocketing millions.
Right. In 1989, he was only 23, but he got convicted on 57 counts of fraud, sentenced to 25 years in prison, ordered to pay back $26 million. The judge had some harsh words, called him a dangerous man because of his glib tongue and ability to communicate, and added, "You have no conscience."
But the story gets even weirder, doesn't it? He supposedly finds religion in prison, gets out, becomes a pastor, writes more books, even consults for the FBI on fraud detection. Looked like a total redemption arc.
Looked like it, but unfortunately it wasn't real. In 2011, he was convicted again for securities fraud, then again in 2014 for embezzling $3 million from his own church.
Unbelievable. Some people just don't change.
It seems that way. The ZZZ Best saga is just this stark reminder that even sophisticated investors can be completely fooled by a charismatic personality and audacious lies, especially when greed gets in the way of due diligence. #tag lessons from history and global context.
Okay, so we've we've walked through the 60s, 70s, 80s, these waves of speculation. What are the big lessons we can pull from all this history?
Well, I think the clearest lesson, looking across all these examples, is just how crucial popular perceptions and investor psychology are in setting stock prices. Often, it seems completely separate from the underlying fundamentals, the actual value of the business. This is where that castle in the air theory really comes alive. You're not valuing the castle's foundation, you're betting on how impressive it looks to the next person. And that makes investing, at times, a remarkably dangerous game.
So for you listening, the practical advice seems pretty clear. Be really, really careful with those hot new issues, those IPOs. The data generally shows most IPOs actually underperform the wider market over time. And if you buy them after they start trading, you're probably paying an even higher premium.
That's right.
Remember, the people selling you those shares are the company insiders, the management. They often choose to sell when things look brightest, either for the company's development or just when investor excitement is absolutely peaking.
Good point.
So just following the crowd into these hot areas, even if the industry seems exciting, can end up being just unprofitable busy work. It's this recurring human thing, isn't it, getting swept up?
It really seems to be hardwired.
And it's not just a U.S. phenomenon, right?
Yeah.
These speculative bubbles pop up everywhere. We should probably touch on Japan's bubbles in the late 20th century.
Oh, definitely. Japan's experience was, in some ways, even more extreme. It shows these forces aren't confined by borders. Let's talk real estate first. Between 1955 and 1990, land prices in Japan rose over 75 times. 75?
That's hard to even comprehend.
The numbers are just staggering. By 1990, Japan's total real estate value was estimated around $20 trillion. That was over 20% of the entire planet's wealth at the time.
$20 trillion.
Get this, the U.S. is 25 times larger geographically, but in 1990, Japan's land was valued at 5 times all U.S. real estate combined. People seriously theorized that Japan could sell Tokyo and buy the entire United States, or that the grounds of the Imperial Palace in Tokyo were worth more than all of California.
That sounds completely insane, like bubble logic defined.
Pure bubble logic. And the stock market was just as wild. It climbed like a rocket up 100 times between 1955 and 1990.
100 times.
At its peak, in December 1989, Japan's stock market cap hit $4 trillion. That was almost 1.5 times the value of all U.S. stocks and nearly 45% of the entire global stock market.
Yeah.
One country.
Wow.
Investors who focused on, rational value were just completely bewildered.
Yeah.
PE ratios in Japan soared past 60 times on average. Stock prices were nearly 5 times their book value. Dividend yields were minuscule, like 200 times earnings.
Compared to the US PE of maybe 15 at the time.
Exactly. And individual companies, even more outrageous. NTT, the big telecom company, its market cap was bigger than AT&T, IBM, Exxon, GE, and GM combined.
One Japanese company worth more than 5 American giants put together. How did anyone justify that?
Well, the Japanese securities industry, their version of Wall Street, had plenty of explanations ready. Were the PE too high? No, they'd say. It's actually undervalued. Japanese companies depreciate assets too much, and we don't count income from affiliates properly.
Okay.
Dividend yield under 0.5%. Oh, that just reflects Japan's super low interest rates, price 5 times asset value. Not a problem. Book value doesn't capture how much the land they own has appreciated.
So they had a convenient story for everything.
Always a story. But critically, those explanations just didn't hold water under scrutiny. Even with adjustments, the PEs were way higher than anywhere else and higher than Japan's own history. Company profitability was actually falling, the strong yen was hurting exports, and while land was expensive, Japanese firms were finding cheaper factory sites overseas. Plus, rents weren't rising nearly as fast as land prices, meaning real estate yields were collapsing.
So the foundations were cracking.
Definitely. And then the trigger. Those low interest rates that fueled the boom started to rise in 1989. The Bank of Japan got worried about inflation, tightened credit, raised rates, hoping to gently cool things down.
But bubbles rarely cool gently, do they?
Almost never. There was no soft landing. The stock market completely imploded. The Nikkei index peaked near 40,000 in late '89. By mid-1992, it was down around 14,300, a drop of about 63%.
63%. That's almost as bad as the Great Crash here in the U.S. from 1929 to 32.
Very comparable in severity, and right alongside the stock market crash in the early 90s, that enormous real estate bubble burst too, with similar declines. It completely shattered the myth of Japan being somehow unique, of ever-rising asset prices. It just dramatically proved that the law of financial gravity, it doesn't care about geography, it applies everywhere.
A universal lesson indeed. Hashtag tag outro.
Unchecked speculation, fueled by appealing but ultimately flawed narratives, always eventually runs into economic reality.
So wrapping this up, what's the core takeaway from this deep dive into historical bubbles for you, our listener?
I think understanding these patterns is just so crucial for trying to recognize similar things happening in today's markets. It really hammers home that point that even the pros, the institutional investors, can get caught up in that greater fool game, buying not on value, but on the hope someone else pays more later.
Absolutely. And that leads us right to a final thought, maybe a provocative question for you to ponder. What new magic words are floating around today? What new concept stocks or maybe even asset classes might be building fresh castles in the air right now? And perhaps more importantly, how can you better equip yourself to spot them? How can you think critically about the investment stories you hear instead of just getting swept along with the tide? Food for thought. And hey, if you found this discussion useful, maybe learned something new, definitely hit that subscribe button. We do these deep dives regularly, exploring valuable ideas.
We appreciate you tuning in.
Yeah, thanks for joining us.